Well, policy seems to be easing at the margin, selectively. What they're doing, I think, is that they're going to ease a little bit more for the rural banks, for banks which are extending credit to the SME sector, because these are two sectors where I think the credit creation has slowed down, uh, partly because of the tightness in the money markets of the last year. So, but there's not going to be any mass easing in terms of broad-based RRR cuts in China. We don't expect that to happen. Well, the easing itself has been taken positively by equity markets, especially the cyclical sectors of the economy, where you've seen banks rally up a bit, you've seen the higher beta sectors do well. Clearly, the general inference from the easing is that growth is not going to fall off the cliff. You probably get growth around 7% for the rest of the year, which should be decent. Uh, in the background of earnings cuts through the course of this year, where, for example, MSCI China's earnings growth has been cut from about 10% or 11% at the start of the year to something like 5% now. Uh, a 7% GDP growth number should be fairly okay in terms of allowing these industrial companies to achieve their earnings growth expectations. So that's why you've seen a bit of a rally in Chinese equities.